Ladies and gentlemen, good day and welcome to the Corona Remedies Limited Q4 FY26 earnings conference call hosted by Ambit Capital. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gaurav Tinani from Ambit Capital. Thank you, and over to you, sir.
Thanks, Ikra. Good morning, everyone. On behalf of Ambit Capital, we welcome you all on the Q4 and FY26 earnings conference call for Corona Remedies Limited. Today on the call, we are joined by Mr. Nirav Mehta, the Managing Director and CEO, Mr. Ankur Mehta, the Joint Managing Director, and Mr. Bhavin Bhagat, the Chief Financial Officer of Corona Remedies Limited. We will begin the call with opening remarks from the management, followed by a question and answer session. Thank you, and over to you, sir.
Good morning, ladies and gentlemen. Thank you all for joining us on the Q4 and FY26 earnings conference call for Corona Remedies Limited. I am Nirav Mehta, Managing Director and CEO on the call, and I am joined by our Joint Managing Director, Mr. Ankur Mehta, our CFO, Bhavin Bhagat, other members from the senior management team, and Strategic Growth Advisor, our investor relationship partner. We have uploaded our result, press release, and investor presentation on the stock exchange and on company's website. I hope everybody has had the opportunity to go through the same. It gives me immense pleasure to announce that we have consistently outperformed industry growth and delivered results that are in line with revenue and PAT, and in fact ahead of our guided range of 15% revenue growth and 20% PAT growth. Our revenue for FY26 grew at 17%, while PAT increased by 33% on a year-on-year basis. This strong performance reflects our commitment to growth, operational excellence, disciplined execution capabilities, and confidence in our long-term strategic direction. Turning to the Indian pharmaceutical market, IPM, the industry has recorded double-digit growth over the past 5 months, which is an extremely positive development for IPM and for all of us. The overall industry trends remain encouraging. With a robust outlook for IPM in the short to medium term horizon, we are proud to have significantly outperformed the market, achieved growth at nearly 2 times the industry rate, and continuing our track record of consistent outperformance. Given the progressive outlook for the industry, we view this as a strong opportunity to further strengthen our presence in the IPM and remain committed to outperforming industry growth, as we have consistently demonstrated historically. As per PharmaTrac March 2026 report, Corona continues to be the fastest growing pharmaceutical company among the top 30 companies in IPM. Our industry ranking has improved to 27th position, moving 5 spots in last 3 years. We are delighted to announce 100% dividend, which is equal to rupees 10 per share for FY26, reflecting our strong financial performance and continued commitment to delivering value to our shareholders. Speaking to specific highlight of the year, we are proud to announce that as per PharmaTrac March 2026 data, 2 of our brands have surpassed the rupees 100 crore revenue milestone and continue to demonstrate consistent growth. We now have 2 brands in the rupees 100 to 200 crore club and 8 brands in 50 to 100 crore club, and we aim to further expand this portfolio through sustained volume growth and continued market share gains. We continue to deliver strong outperformance in chronic and semi-chronic therapy segments. With these businesses, now we are contributing 72% to our overall revenue as per Pharmatrack Net March 2026 data. This reflects our strategic focus on building a sustainable, high-growth specialty business driven by improved prescription stickiness, better patient compliance, and long-term market opportunities. Our consistent performance in these segments reinforces the strength of our portfolio, field execution capabilities, and deep engagement with the healthcare professionals. To further strengthen our presence in women's healthcare, we have established a dedicated IVF task force in Q4 FY26, which become our fourth focus team in the women's healthcare segment. This strategic initiative will enable us to effectively capitalize on the opportunities arising from the Bayer-Zydus relaunch portfolio, which also deepening our footprint in the rapidly growing infertility market. We have successfully completed two strategic acquisitions in FY26, the recent acquisition of Vocadin and the earlier acquisition of the Bayer portfolio, whose relaunch was initiated in Q4 of FY26. The acquisition of Vocadin, which is ranked 2 in the Indian povidone iodine market, enables us to enter into 650 plus crore povidone iodine market, strengthening our presence in targeted specialties. Both the acquisition reflect our focused strategy of building high potential brands and expanding our market leadership. We also have marked our entry into biosimilars and biologics market with the launch of 3 biosimilar products in FY26, that is Fostin R, Tricium Dweb, Vintide and Tyvenza. The biosimilar and biologics space offers substantial long-term growth potential, driven by increasing adoption of advanced therapies, expanding patient access, and growing demand for cost-effective treatment and alternatives. These launches will not only diversify our portfolio, but also create a strong platform for future growth and innovation. We are undertaking expansion of our manufacturing capabilities through the addition of new 600 kg line expansion, alongside the commissioning of our dedicated hormone manufacturing plant, which is expected to become operational in Q1 or Q2 of FY27. In addition, the receipt of EAEU GMP certification marks an important milestone in our international growth journey. This certification enables us to assess and expand our presence across key Eurasian markets, including Russia, Belarus, Kazakhstan, Armenia, and Kyrgyzstan. This capacity enhancement and certification will further strengthen our manufacturing backbone, improve scalability, and support our growing domestic as well as international business. Our strategy for further growth is to remain focused on increasing market share across key therapeutic areas by strengthening our chronic and subchronic portfolio and offering products across the patient life cycle. We will continue to drive growth through targeted new product launches addressing unmet patient needs, supported by brand extensions, acquisition, and in-licensing opportunity of our India business. We are also deepening our engagement with the specialist and super specialist prescribers through our strong medical representative network to enhance our presence in high-value therapy segments. Backed by our diversified portfolio, strong brands, expanding distribution network, experienced leadership team, and the disciplined financial approach, we remain confident of delivering consistent growth and stable profitability. We expect to sustain 15% plus revenue growth organically and 25% revenue growth in acquired brand with 20% plus PAT growth in FY27 too. So I would now like to hand over the call to our CFO, Mr. Bhavin Bhagat, to take you through financials and operational performance. Thank you so much, and over to you, Bhavin bhai.
Thank you, Nico bhai. A warm welcome to everyone to our Q4 and FY26 earnings call. I will take you through the financial performance for the quarter and full year ended 31st March 2026. Speaking of quarterly performance first, revenue for Q4 FY26 stood at rupees 353 crores versus rupees 294 crores in Q4 FY25, reflecting a healthy growth of 20.2% YOY basis. EBITDA stood at rupees 62 crores versus rupees 54 crores in Q4 FY25, reflecting a growth of 14.4% on a YOY basis. EBITDA margin declined by around 90 bps and stood at 17.6%. Decline was on account of increase in employee cost with respect to additions of two new divisions, that is, one in multi-speciality and one in infertility division, and increase in the corresponding other expenses related to medical reps and increase in the spend for R&D during the Q4 FY26. However, let me tell you all, these are all growth investments which will reap benefits for the future period. Profit after tax stood at rupees 45 crores compared to rupees 31 crores in Q4 FY25, reflecting a growth of 44% YOY basis. Speaking of our FY26 performance, revenue for FY26 stood at rupees 1,403 crores compared to rupees 1,196 crores in FY25, reflecting a growth of 17.3% on a YOY basis. Revenue growth for IPM market stood at around 8.6% for FY26. Our revenue growth in FY26 was driven by a 3% increase in volumes, significantly outpacing the IPM of 0.7% volume growth by nearly 4.6 times. Similarly, growth from new product launches for Corona stood at 6.4%, which is almost 2.6 times more compared to overall 2.5% growth for IPM. EBITDA for FY26 grew by 22.3% on a YOY basis and stood at rupees 293 crores. EBITDA margin has seen a healthy improvement of around 80 bps. EBITDA margin for FY26 stood at 20.9%. Adjusted profit after tax, excluding the impact on account of one-time labor code changes for FY26, stood at rupees 199 crores compared to 149 crores in FY25, reflecting a strong growth of 33.4% YOY. India business contributed around 96% of the total revenue for FY26. Revenue contribution from chronic segment stood at 71.9% in FY26. Cash flows have been a cornerstone of our growth journey and will continue to remain a key strength for the company. Over the past 2 decades, we have maintained a strong track record of EBITDA to operating cash flow conversion, enabling us to consistently reinvest in the business and drive sustainable growth. Supported by disciplined cash flow generation, prudent capital allocation, and steady profitability, we have continued to maintain healthy return ratios while remaining a net cash surplus company. For FY26, our cash flow from operations stood at around 229 crores with CFO to EBITDA conversion at around 78%. Our return ratios also remained robust with ROCE at almost 41% in FY26 and ROE at 29.2% in FY26. With that, I would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pratik Dharmshi from Union Mutual Fund. Please go ahead.
Yeah. Many congratulations, Dhirubhai and the team, for a splendid set of numbers. My question is on margins. So we saw employee cost inching up this quarter. and our margins getting impacted, how should one look at margins structurally from medium-term point of view? Is 17-18% a range one should work with, or this was aberration and annualized 20% plus is a number which one should bake in?
Thank you so much for the appreciation. I request Bhavin Bhai to answer the question.
Hello. Your question is very apt on the margins, but just before coming to the margin, let me first reiterate our philosophy. Our philosophy is to grow 15% on a revenue and 20% on a PAT basis on a year-on-year basis for coming 3 to 5 years down the line. Having said that, answering to your question on the EBITDA margins, would like to share that yes, in Q4 there was an increase in the employee cost with the expansions which we made, which we mentioned in our commentary. But if you see from a full year basis, FY26, you can see the EBITDA margins of 20.9%. So we have improved our margins on a year-on-year basis by 80 bits. Having said that, for the coming years, we would like to continue in the form of our improvement in the EBITDA margins in the form of productivity improvement.
Sure. So this was related to MR increase, right, for this quarter?
Yes. Yes.
And now the number is sustainable, or do you reckon this is an ongoing expense which we will continue to see, or now you are comfortable with the MR strength?
So for FY27, you are absolutely right. We are comfortable with the existing MR strength.
Got it. And second question, you mentioned briefly on biosimilars and biologics as a big opportunity for us. What will be the path we will try to go for? Will it be more organic driven, or we are open to inorganic opportunity in that space too? Thank you.
So more or less, biosimilars has been in two ways, either in licensing or it is organically. Hypothetically, when we are entered in the market of semaglutide, it is organic route. While in the case of recombinant follicle stimulating hormone, it's in licensing or it is out licensing sort of thing. So we are open for all the things as far as complex, generic and biologics, biosimilar is concerned.
Got it. Once again, many congratulations. Thank you.
Thank you, sir. Thank you.
Thank you. Before we take the next question, a reminder to all the participants. If you wish to ask a question, please press star and 1. The next question is from the line of Amey Chalke from JM Financials. Please go ahead.
Yeah, thank you for taking my question and congrats to the management on good numbers. So first question I have is on the revenue growth breakup. Is it possible to give the domestic and the export breakup for the quarter and the year?
Yes, Amey bhai. As far as the Q4 FY26 is concerned, the breakup of growth of 20.2% revenue is as follows. Domestic growth, we have 18.3%, whereas international business growth is 70%, which is totaling to 20.2% for Q4 FY26. And for the full year FY26, our domestic/India business growth comprised of 16.81%, whereas the international business comes to 29.5%, which culminates to overall 17.3% revenue growth.
Sure. And internally, when we break down this 16-17% India growth, is it in line with the IPM breakup given in the volume, new product and price growth, or is it starkly different?
So, Amey bhai, we are above the IPM in all the three: volume, price, and new introductions, as far as the growth is concerned.
Sure. And going ahead also, you expect to remain on a higher side in terms of volume and new products, right?
Yes.
Right.
Absolutely.
And the second question I have is on the gross margin front, because this year we have seen a good expansion in gross margin to 81 plus. But I believe next year would be an inflationary year where the RM costs have already started going up for most of the APIs. So how do you see this gross margin staying at this level for next year? And what levers we have to maintain this gross margin at a higher level?
Okay. So So first of all, as far as gross margins are concerned, it is 81.4% for FY26 full year.
Right.
We have always said in our commentary that we would be maintaining the gross margins at the range of 80% in the coming years down the line. Yes, this will, so how we will achieve 80%, to be very honest, or whatever we have at this moment, is we have a strong, robust product mix involved, which helps us to grow and sustain our gross margins. So the gross margins where we are, we would be sustaining at the level of 80% in coming days down the line or coming years down the line.
Sure. And is it like, do we have the WPI number from government for which we would be eligible to take price hike for non-NLM products next year?
So as far as NELM is concerned, the government has given the guideline on WPI, which has been less than 1% as far as WPI is concerned. And as far as non-NELM is concerned, it's been always a 10% guideline. As far as Corona is concerned, we have about 92% non-NELM and 8% NELM. So it doesn't impact much to us as far as NELM and non-NELM is concerned.
Got it. So we have good lever on the price hike side because of that 10% non-NELM exposure. Got it. And the last question I have on the debt side, there is slight increase on the short-term borrowings every year over last 3-4 years. So is it related to working capital or anything? If you can clarify on that. Thank you so much.
So Amay bhai, a very well pointed question, because I always tell to our investors that we are a net cash company. So having said that, answering to your question on borrowings, if you can see in FY26, it is reflected as 143 crores in the form of borrowings. So first of all, let me tell to all the investors and everyone on behalf of you that we don't have any single cash credit facility from any banks. We avail the facility, but we don't use it at the end of the day. This 142.9 crores borrowings is only because of the overdraft, or majorly because of the overdraft on the basis of FDs which we have. So we have FDs on the asset side and we have overdraft on the liability side in the form of borrowings. So if we net off, our net cash is 15 crores and the rest only 16 crores borrowing is there, which is in the form of a long-term loan of Myovil which we took over, which will be paid off in this year. Hence, there would be no borrowings in our books, only in the form of FD-OD. And why this OD has been created? Because we acquired a brand named Bocadin on the last day of the month of the March. So that was the reason this overdrawn facility was being used. Else, there are no borrowings in the books of accounts.
So, thank you so much, sir. Well explained. I will join back with you. Thank you so much.
Participants, you may please press star and 1 to ask a question. We will take a next question from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Hi, good morning, everyone, and thank you for the opportunity. Sir, first question, excluding the spends on the 2 new divisions and the higher R&D spends which Bhavin bhai mentioned, are there any other structural reasons that drive lower margins in 4Q versus the first 3 quarters?
No, Alankar bhai. These are the only reasons which you mentioned.
But then, Bhavin bhai, if I look at the margins... Yeah, sorry, sir. Go ahead, please.
Sorry. So I was just adding to it. So if you look at the Q4 numbers from an employee cost and the other cost standpoint, in the Q4, 9 crores was additionally spent in the form of the forming of 2 new divisions and deployment of MRs, and the MR expense of almost 5 crores, which is being standing in other expenses in the form of an MR expenses, in the form of allowances which we give to them. So more or less 9 plus 5, 14 crores relates to the employee related cost and 1.6 crores relates to the BE cost, which is in R&D nature. Bioequivalent. If you remove this from the Q4 EBITDA, I think the numbers would be fabulous as far as the percentage growth is concerned.
Got it, sir. Sir, the reason for asking that question is, I was looking at 4Q margins in the last year as well, and even if I adjust for this 14 crores for this quarter as well, the margins in fourth quarter are lower compared to the first 3 quarters. So just trying to understand from a seasonal standpoint, is there anything which you would like to call out when it comes to the fourth quarter?
No. So Alankar bhai, as we have stated earlier also, I understand we evaluate quarter on quarter, but if you look at overall a journey, if it has been evaluated first half to the second half, it gives a more appropriate picture. And quarter four, more or less seasonality, plus launching new two divisions. So, there may be that reason. Otherwise, more or less, it will remain same.
Okay. The second question then, Nirav, is if I look at slide 16 of your presentation, the pricing growth as reported by PharmaTrac is around 7.8%. Intuitively, that seems pretty high and maybe even higher than what we have reported previously. So just wanted to understand what is driving this and is this sustainable?
So it's absolutely sustainable. The reason is only about our 93% portfolio of non-NELM, and we are always been affordable on the other side of the coin, more or less. Our product range, there is a space of increment of the price revision. That's how we have taken that lever as lever. But at the same time, if you look at the volume growth, which is 4.6x than the IPM and 1.4x as compared to the price growth. So it's absolutely sustainable, Alankar.
Okay. And related to that, Nirav, I mean, Middle East, the impact of that, any thoughts also when it comes to gross margins over the near term? Do you foresee any risk to that 80% number you mentioned earlier?
So to be very honest, too early to comment onto it. As we have about 90 days to 120 days inventory been available, we have started taking the impact on it. And because the oil and the other parameters impacts many active pharmaceutical ingredients, so that will impact for sure. But if this situation has been controlled in a 1 month of time, I think so the impact is negligible. If it goes little long, it may have a little more impact, but too early to comment on the subject.
Got it, sir. Maybe a final question from my side on the 7 brands from Bayer. Yeah. Sorry, am I audible?
Yeah.
Go ahead.
Just to increase, give an incremental outcome on the margin push and all. We have very less import. That also will making us more comfortable, but still little long to conclude on the effect on gross margin as far as year is concerned.
What would be the share of RM imports for us, sir?
It's been less than 1%.
Acha, so basically 99% is sourced domestically.
But that API manufacturers also impact on oil and other things, So it's indirect impact to us, but we are trying to balance the coin. Let's see, when this situation is under control, I think so then and then we can able to give you the idea, at least by the first quarter guideline जब आएगी तब उसके साथ शायद हम बता पाएंगे और
Fair enough, sir. So the other question I had was on the 7 brands from Bayer Zydus. You spoke about the new division on infertility, but any thoughts, any more qualitative color on the progress over there? Can you talk a bit about the sales numbers coming in from these 7 brands and what are your expectations going forward?
So I think so the orientation is this brand has a great legacy for last 2 decades in the IPM. The promotion has gone little slow because of the priorities of the earlier company. But now we have gone and launched that brand in the Indian market. The first initial response has been pretty encouraging, and we are expecting really we can do wonders as far as this brand is concerned. There are 2 reasons to it. A, there is a legacy in the mind of the customer and the quality trust, and the 2, we have a leadership position in women healthcare business. So I think so with these 2, we are expecting high with the launch of this infertility division. And I think so next 3-4 months we can get more colors and more idea onto it. But the initial response is very encouraging.
Got it. And one final big bookkeeping question, if I may. Bhavin bhai, what were the advertising as well as sales promotion expenses in FY26 as a percentage of sales?
It is in tune of 19%. 19.
Both advertising and sales promotion put together, you are saying?
Yes, put together.
Okay. Possible to provide the split?
Yeah, we can possible see it is more or less in the form of sales promotion. If I just dissect the things, 10% would be in the form of consulting,
Advertising.
consulting agreements with the key opinion leaders. 5% would be in the form of S&D promotion spend, and 4% in the form of scientific conferences.
Got it, sir. That's very helpful. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Siddharth Negandhi from CWC. Please go ahead.
Congrats on the set of numbers and thanks for the opportunity. Just wanted to understand three things. One, what is the PCPM that you've had currently? How are you seeing that PCPM grow over, say, the last 3 years in terms of productivity, which you called out? Second was, you spoke of exports growing faster. Is that tailwind or a headwind to your gross margin and your EBITDA margin? And the third one, just wanted to understand, while I understand that given the Indian context, obviously, relationship-based selling with relationship-based sort of selling and discussions with doctors is important. But in that context, is there anything specific that you're doing on, improving engagement with doctors through AI? Yeah, those are my three questions.
Yeah, thank you so much for asking the question. As far as PCPM is concerned, today we have a PCPM of 4.11 lakhs. So it is 4,11,000, which was last year about 3,62,000. So about increment of about 50,000 rupees PCPM from 3.62 to 4.11. As far as doctor practice is concerned, which is your third question, we are adhering the UCPMP, that is Unique Code of Marketing Practices, as a part of the practice. So we don't do any hanky-panky things as far as business is concerned, and we adhere UCPMP. So whatever expenses we are doing, it's under the purview of UCPMP strictly. And this has been a story since last a decade. We are adhering to UCPMP as the guideline. About your second question, you asked about export, but I forgot the question what you asked. Can you repeat it?
Is gross margin and EBITDA margin for exports better than domestic or significantly lower?
So it's always gross margin been lower and EBITDA been upper. Because we are adopting the B2B model as far as international business is concerned. In B2B model, and India we are working on B2C model. So when you are working on B2B model on international business, it's been a less gross margin and more EBITDA, while in B2C it's other way around.
Right. And just two follow-ups on that. So, sorry, the third question was more on use of AI for improving doctor engagement. If there is anything specific that you're doing, if you can share that. And on your growth guidance of 15%, how should we think of that domestically versus exports?
So, as far as AI is concerned, we have started using AI in multiple level. As far as marketing practices is concerned, we are utilizing SFE, that is Sales Force Effectiveness, as a tool, which gives a more robust critical analytic tool on a daily basis to a concerned medical representative about their last visit, last discussion to the doctor, new scientific indications, new scientific discussions for the doctor, and ongoing scientific knowledge also. So we are using this AI technology for our sales force effectiveness. And as far as doctor is concerned, we are using AI tool for more diagnosis, sort of purpose, try to help them on diagnosis, on the prescription writing tool, which gives them a record of the prescription, etc. So we are working on both the ways. To the medical representative, we are designing one tool, and for our customers, we are designing one tool. As far as 15% organically revenue growth is concerned, we are committed for 15% organic domestic revenue growth domestic and international put together. More or less, international is about 4% to the business. So it doesn't impact much here and there, but 15% organically. And inorganic portfolio which you have acquired, we are committed to give 25% revenue growth in inorganic portfolio we have just acquired, and 20% plus profitability as the guiding force for now and for another 2-3 years at least. We are seeing the visibility for this.
Thank you so much. Thanks a lot.
Thank you. Next question is from the line of Amit Chalke from JM Financial. Please go ahead.
Yeah, thank you for giving a opportunity again. So I have one follow-up question on export. We have written that the Bhaila unit will give us entry into some of the key markets in the export side. So is it possible to explain our strategy here and how much export revenue should scale up once we start launching products in some of the geography over the next 2 years?
Yeah, Amit bhai. So as far as international business is concerned, Bhaila plant is already been Europe approved. We have got accreditation from EU, which opens the door of Eurasia market. And, it will take few more years, around 2 to 3 years, to really kick off the business in the European market, Euro-Asian market, because we've already been in the process of filing the dossier. It will take typically about 1.5 years to 2 years of time to register the product in that particular country, and then we'll go all out. So moving forward, next 4-5 years, I think the next 3-4 years at least, I'm seeing high single-digit CI for international business, about 8-9%, and 90% plus CI with the India business. India business has been on the focus, and we have a deep root in India business that is continued. With that, international business will also grow up in years to come.
Sure. And this export strategy would be brand specific or across the brands you will sell it is brands agnostic basically, like you would be selling as per the demand from the distributor.
So more or less, it's been on a therapy basis. We say, as far as international business model is concerned, there are two things. We are talking all about Think Hormone, Think Corona in all international platforms. And number two, we are talking about B2B business. So it's more a therapy driven, a hormone as a therapy, and the portfolio added with the few other supported brands in that particular portfolio.
Got it. And another question I have on the Bayer side. So we have acquired the 7 brands. So from these 7 brands, you see any strong potential for any of the one or two brands which can become really big, or you think that will act as a portfolio going ahead? Because some of these brands like Menodac, Ovidac, they worked on a life cycle, right?
Yeah. So there are 2 brands which have really been arrowhead, and we have high focus on these 2 brands also out of the portfolio. One is Menodac, that is HMG 75, 150, 300, 600, and 1200. And number 2 is Phosphine R, that is recombinant follicle stimulating hormone, FSH. These are the 2 arrowhead brands, and this will be the arrowhead for the division also.
Sure. And you believe that these brands have potential to become like a 50 to 100 crore type of brands over the next 4-5 years?
First, we will focus to make this portfolio 50 to 100 crore, and then definitely this brand has a potential to become big.
Sure. Thank you so much. I will join back. Thank you.
Thank you. Next question is from the line of Gaurav Tanani from Ambit Capital. Please go ahead.
Yeah, hi. Thank you. Sir, what would be the MR strength today, and what would be the net MR addition in FY26?
So it is about 2650, and we have added about 450. Put together today, we have a MR strength of 3,100.
Got it. And apart from infertility, this was a new division which was launched in Q4, right?
It is a restructuring of the multi-specialty division as we have 200 crore plus brand, B29 and Mayoril. We want to give a focus to the brands and hence we have done restructuring in multi-specialty division. So that's the second division we are talking about, that is multi-specialty.
Okay. So coming to, two recent launches first, picking up semaglutide. So, can you talk more about, who is your manufacturing partner for this product and, what is the go-to market strategy for this? Do you have a dedicated division? And how do you see this product scaling up for you, over the next year or next 2 to 3 years, please?
So as far as semaglutide is concerned, I think so that's been, exciting market to be, and we are in that market with MSN as the partner manufacturing company. So there are 2-3 other companies with MSN, and we are one of them. As far as semaglutide is concerned, we have launched 2 brands. One is Vintide for our, super specialist endocrinologist and diabetologist in one division, which is focusing more on the specialist to super specialist. And the other brand is Tivenza, which try to cover the, tier 2, tier 3 market, rural market, tier 2, tier 3 market to the specialist. So I think so this semaglutide market is concerned, people are talking to anticipate this market on a first year from 500 crore to 5,000 crore. And it's a big range, people are seeing with this market. My own understanding is, and the calculation is, if in India there are about 10 crore eligible patients for the semaglutide market, and if conversion ratio is about 2-3%, and the therapy cost, if we calculate, I think so first year maybe a year of 2,000 to 2,500 crore as the semaglutide market. That is my anticipation. I think so in another 2-3 months of time, we can have the greater clarity on the market. But yes, semaglutide brings a new dimension to the diabetic market as well as obesity market, and generic semaglutide market has been exciting for sure.
Oh, very helpful. Thank you for that, sir. So secondly, on Vocadine, which you acquired, so a 20 crore kind of a top line product, under NLEM, price multiple paid was, somewhere closer to 4.5 to 5 times. So how do you think, you would scale this product from 20 crores over the next 2-3 years? And do you see any cost synergies also here? Because given it's an NLEM product, price hike may not be viable. But, by changing the source or something, you can derive some cost synergy. Any insights on how you plan to ramp up Vocadine?
Yeah. So thank you. So as far as Vocadine is concerned, as you rightly said, it's 20 crore brand, and we are anticipating about 25% revenue growth for at least 3 to 4 years in the Vocadine. And what I understand, as far as 14 different SKUs of Vocadine, few are out of NLEM, and majority of are in NLEM. Now we have tweaked the strategy in the way that we will, do some focus metrics onto the non-NLEM portfolios of Vocadine. Resulted, we are anticipating about 400 basis point of gross margin correction in the first year. It will take some time, but we are pretty sure, and we have taken that also in the consideration with 25% growth and 400 basis point of gross margin correction in first year, and then we'll see that how this portfolio will grow. This 400 basis point can be a 600 or 700 in a year to come. That will decide by the next year. But we are pretty sure about 400 basis point of gross margin correction and 25% of revenue growth.
Got it. This is also. So, I think last, question from my side. So you have the Zydus Bayer portfolio ramp up driving growth this year. You have Sema and Vocadine also adding to growth this year. Apart from this, any other, new launch or significant launch that you see in FY27?
FY27 has been a classical, exciting year for Corona for sure. Reason being, addition MR, the additional multi-specialty vertical will fuel the revenue growth. New biosimilars and biologics will fuel the growth, and the acquisition brand will also fuel the growth. So that's where, we are pretty sure and we understand that we can able to grow 15% organically and 25% on the inorganic portfolio, considering 20% plus PAT growth for sure.
Great, sir. All the best. I have no question. I'll join back with you. Thank you so much.
Thank you. Next question is from the line of Shrikant Akolkar from Nuvama. Please go ahead.
Hi. Thanks for the opportunity. I have a question on margins. So we have 81% gross margins and about 21% EBITDA margins. So what are the measures to be required to consider if you want to move our margins, and what is currently under play so that we can get that 24-25% margins in next 2 to 3 years?
So Shrikant bhai, yes, answering to your margins first, but as we mentioned earlier, that we focus more on 20% PAT growth for years to come, and this is our endeavor, and this we will achieve. Having said that, your question is on EBITDA margins. EBITDA margins will definitely come in play with operative effectiveness in coming years down the line. As we have improved 80 bps in this financial year, in coming years as well, if you see the synergies will come in the cost, and with the increase in our 15% plus revenue growth, operational margin will definitely improve.
Okay. And we have hired 450 MRs. So just want to understand what is the time required for the sales force to achieve peak PCPM, and what is the target PCPM that we are trying to achieve in next 2 to 3 years?
Okay. So Shrikant bhai, just to brief you first about our philosophy, we have dissected our medical reps into 3 segments. One from 0 to 3 years, that is we have PCPM of 2 lakhs. One from 3 to 6 years, where we have PCPM of 4 lakhs. And one from the MRs who are in the company from more than 6, 7 and 8 years, where the PCPM is 6 lakhs, 7 lakhs and 8 lakhs. So this is the journey of an MR in our organization, correlating with the PCPM what they generate. Right now our PCPM is 4.11 lakhs per month. So this is what we would like to share, that as my aging of my employees in the organization increases, the PCPM definitely increases.
Okay. And for the current set of new hires, how long do you think they will take to achieve that peak? Maybe 3-4 years. Is that the right assumption?
Sir, I think you should keep the numbers in the 3 buckets what I shared: 0 to 3 years, 3 to 6 years, and 6 and above. So as the MR progresses in terms of tenure in the organization, the PCPM progresses.
And just to add, Shrikant bhai, onto it, and we have launched one multi-specialty division, which is, we have dissected 2 multi-specialty division into 3. So more or less brands were there, availability were there, but we would like to focus on that. So by that way, we can expedite the speed of the productivity for sure. While launching absolutely a new therapy or a new vertical, it will take, little longer time than the restructuring sort of thing. Just to academically answering your question on Corona philosophy since years together.
Understood. Okay, last question. So we are planning to get into European and Asian markets. Now, can you talk about the margin profile of these markets, and would it be dilutive to our margins, and how should we think about the working capital requirement in these markets? Thank you.
So as far as working capital is concerned, more or less it is from the internal accrual, because what we want, what we need to do the R&D and bioequivalent studies with the R&D and creating a dossier which is a world-class dossier. So it's been taken care with the internal accrual. As far as I said earlier also, we are going in this market with B2B model. In any B2B model, more or less it's been less gross margin and more EBITDA. So it doesn't make any difference in our philosophy of 15% plus revenue growth and 20% plus PAT growth. It will remain unchanged with the international business too. And look at the international business horizon. It's been about a higher single digit to lower double digit, versus India market is about 90%. So it doesn't impact anything onto the overall kitty of Corona.
Thank you so much for answering my questions.
Thank you, sir.
Thank you. Next question is from the line of Rahul Jivani from IIFL Securities Limited. Please go ahead.
Yeah. Hi, sir. Thanks for taking my questions. So, Nirav bhai, you alluded in your opening comments that the IPM growth has accelerated over the past, let's say, 5 months. And what we also see from external data is the IPM growth, which was around 8-9%, has now ended up to a 10-11% kind of a number. And that acceleration essentially has been volume driven. So volumes which were, let's say, nil at an industry level are now growing at 1.5 to 2% kind of a number. So what, according to you, has led to this volume acceleration for the IPM over the past 5 to 6 months? And how sustainable do you think this trend is for the industry, let's say, going forward?
So thanks, Rahul bhai. If you remember, Rahul bhai, we had a discussion on this. But let me tell you, I was anticipating this since last 6 months, that by November, December, industry will start giving the double-digit growth, and this is sustainable for at least a year, because that has been anticipated in the mind. And the very simple reason, this industry has always performed about double-digit growth or higher single-digit growth since last 25-30 years. In between, there is a COVID and post-COVID and post-COVID. So more or less, it's been about pandemic and pandemic effect for 4-5 years. Now this effect has been narrowed down, and industry is coming back to the higher single digit to double digit growth. I am anticipating about 10 to 10.3% overall growth as far as this year is concerned, with the volume growth of about 1.5 to 2%, and rest is price and NI. So I am been very optimistic as far as IPM in FY27 is concerned.
Sure, sir. So this 10 to 10.3% growth for IPM for FY27, do you budget in GLP-1 contribution, or this should be the base growth for the IPM X of GLP-1?
No, I have not seen. When you're talking about, Rahul bhai, 2.5 lakh crore market, versus if we're talking about 2,000 crore market, I think so I have not nailed down this with this. I'm talking in total about a 10.5%, 10.3, 10%, sort of 10 to 10.5% growth in the IPM.
Sure, sir. And typically in the past, let's say our volume growth outperformance versus the market has been around, let's say, 4 to 5x. So with let's say the IPM volume growth itself picking up, as you pointed out, would we see an acceleration for our volume growth as well?
Yes, sir. By adding the medical representative and restructuring the multi-specialty division and adding this Vocardin into it, that's a new product, I understand. But overall, we are expecting about 3 to 4x volume growth as far as our growth is concerned.
Sure, sir. That was it from my side. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you all once again for joining us today on the Q4 and FY26 earning call. We will keep the investor and analyst community posted with any updates relating to Corona Remedies Limited. We hope we have been able to address all your queries and been committed to 15% revenue growth organically and 25% revenue growth on the acquired portfolio, with 20% plus PAT growth in FY27 too. For any other information, kindly get in touch with us or SGA Strategic Growth Advisor, our investor relationship partner. Thank you so much and have a great day ahead.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you all for joining us today, and you may now disconnect your line.